Hi, Tamal. Welcome to the Business Standard Banking Show. This week in your column, I read you've written about the systemically important banks. Now, the subject itself is not new, and RBI has been talking about systemically important banks for some years now. So, what was the trigger for you to touch upon this topic? That's the first question.
Very smart, Ruchika. Yes, this is not a new thing. It's, I think, for the seventh time, Reserve Bank of India has come out with a list of systemically important banks. The trigger is, yeah, over the year end, I would not say flooded, but there are many messages and many phone calls from people I know and don't know, asking me whether their money is safe in Bank A, Bank B, Bank C, Bank D, etc., etc. Those banks which are not part of this list of three, which are systemically important banks. So that's what I thought. Let me write a column, explain what it is, and how do you see depositors, the other banks.
Tamal, now that you've said that there were concerns among people, for our viewers as well, can you then explain what are these banks and why depositors don't need to worry about if their deposits are not in these banks?
Well, it's the systemically important bank has actually replaced the concept of too big to fail, and again, the Lehman Brothers collapse was the sort of trigger, because once you become too big to fail, your advantage is this for the entity is this: you can access money both in terms of, say, NCDs, bonds, of course deposit. It is, I mean, with bit of an ease. For you, it's far easier than other banks. But then, there is a moral pressure on the government to step in for the rescue if such an entity falls too big, because it's too big to fail. And that also may encourage these entities to take higher risks. So, which is why that was the origin of the concept of systemically important banks, to replace the concept of too big to fail. And it's an international practice now. Globally, the JP Morgan tops the list. And in India, State Bank of India, and then HDFC and ICICI Bank. So these banks actually, to Reserve Bank of India here and globally, other banks as well, as I said, is this: they need to have more capital. I'm not getting into the technicalities. They need to have more capital to support their growth and to support their size, so that the government does not need to come in for the rescue for any one of them if they fail. So it's not that they're too big to fail. They are systemically important banks, and to remain so, and because they're so big, they're treated in a different way. They're different from other banks. They would need little more capital. I'm not getting into all the technicalities. Little more capital. So the top, which is the top tier, there is no Indian bank there, and the top tier globally also there is no bank there. But SBI, among the Indian banks, SBI is the most important bank, followed by HDFC, followed by ICICI, and globally JP Morgan is the most important bank. But it does not mean that it does not mean that your money, my money, is not safe with any other bank. All banks are safe, and not cooperative banks I'm talking about. Scheduled commercial bank, not a single bank has been allowed to fail since economic liberalization in the 90s.
Absolutely. Now, we're talking about banks, and it's the results season, and we've had some important bank results that have come in. What are some of the macro trends that you are seeing emerging from these results?
Thanks, Ruchika. Before the macro trend, let me tell you one micro story, which is well known now, the story of HDFC Bank, the margin pressure. I think HDFC, because of the size, finding it difficult. The growth in deposits need to be much higher to keep pace with the credit growth. So it has to find its ways to manage it. Now, if you leave that apart, that's of course is a macro story for the entire industry. But quickly, what are the trends that we are seeing for the banks earning this session, December quarter? One, of course, the so-called AIF, Alternate Investment Fund. They are, because of RBI insistence, the banks had no choice but to provide for it. So that has eaten into their profit to some extent. Second, you will find that, of course, the credit growth is continuing, but deposit growth is not keeping pace with the credit growth. So the CD ratio is going down, going up for many banks, and they need to figure out what's to be done. I mean, they need to raise capital for money, not substituting deposits. Capital has a different cost, higher cost, but they need to go for that. And of course, they need to focus on their deposit growth. Otherwise, they need to rein in their growth. And finally, the margin pressure, which is the story for the entire banking system, I would say. The deposit growth is not keeping pace with credit growth, and the cost of deposit also is going up. As we see that the saving community is exploring the other investment avenues, including direct equity exposure, apart from mutual fund and other things. And within the deposit growth, the structure is changing. The low-cost CASA is going down. FD, which is more expensive, is going up. Now, if that's the story on the deposit side, if you see on the credit side, now they have not been able to raise their loan rates because I would like to believe about 70 to 80% of the credit loan portfolio is floating rate. And now within the floating rate loans, the majority part, again, probably 70-80% of that would be EBLR or external benchmark linked rates. And the rest of it, maybe 20-25% would be MCLR. Now, while MCLR is linked to cost of funds, which means MCLR can go up, has been going up. Many banks have announced that keeping in pace with the cost of deposits, higher cost of deposit. But EBLR cannot go up because they are linked to either repo rate or 364 days treasury bill or 6-month treasury bill or 10-year paper yield. Now, if you see that all these, except for at this point of time, except for 6-month treasury bill, all the other benchmarks are either flat or going down. So which means banks cannot raise their EBLR, which is bulk of their loan portfolio. If they can't, while the cost of fund is going up. So that's the classic case of margin pressure, and they need to find ways. Otherwise, they would need to rein in their credit growth. So we need to keep a very close watch how this pans out in the fourth quarter. Thanks, Ruchika.
Well, Tamal, you have laid to rest any fears that depositors might have had about the reshuffle in the list of the systemically important banks. And of course, very rightly pointed about the results as well. NIMs are under pressure, and we will continue a watch on this evolving situation. Thank you so much, Tamal, for joining us today. We will see you next week.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.